People on the internet are always going to be a special breed. I've been getting a lot of messages from people saying I'm glad I didn't listen to you and buy Baba when you recommended it on your YouTube channel. And on the surface, they do seem like they're right because the share price of Baba has done nothing but crash to as low as $150 per share since the release of that 6-part video series on Baba. So it seemingly looks like I have some egg on my face as they are right. Or are they? Is Alibaba a bust and should we be cutting our losses and just running at this point? What exactly is the guy who made the 6-part series on Baba doing now that the stock price is cratering? In this video, we're gonna cover just that. You're watching Moor Money? Let's get it. What's up guys, Tay here, and let's get right into it. So the Baba stock price has collapsed. It went as low as $150 a share and has recovered to approximately $170 per share as of the recording of this video. Since I batch record, this video may not get released for a couple of weeks, which means that the share price could recover by the time this video is out, or it could be much lower than where it is today. So keep that in mind as you watch this video. Now guys, you gotta understand that saying things like, I'm glad I didn't listen to you and buy Baba, may be one thing when you say it to other retail investors, but when you say something like that to someone who's a little bit more professional and has done it for so many years, it doesn't have the same impact that you think it does. You actually come off as an amateur who takes his cues from being right or wrong based on the movement of the stock price. People that have invested for decades understand that in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine. This means that if the business is sound and operating well, sooner or later, the share price will reflect the success of that business. Now, long-term professionals who don't really have investors to worry about mostly turn off the stock market subsequent to making a purchase and take their cues of being right or wrong from the performance of the underlying company. So in other words, when you say things like that, like, oh, I'm so glad I didn't buy it when you bought it, you kind of just look like an amateur, and the professionals can see that you're not really good at this. Buying when the stock is going down is the hardest but most profitable endeavor. For example, people were laughing at me when I was betting the house and buying up stocks from February 28th to March 16th of 2020. I was buying so much stock at the time that I was even using non-callable lines of credit just to buy more securities when they were on sale. Did I catch the bottom? Absolutely not. I never do. Did I expect the market to be down for 2 to 5 years? I definitely thought it was a probability, but I bought anyways because the valuations were amazing. I was fully prepared in early of 2020 to have my stocks go in the red and stay in the red for a long period of time because I believed in the underlying operations of the companies that I was buying. And I did believe in 5-10 years that the share prices of these companies would be significantly higher because they eventually would have to reflect the success in the operations of the companies. And honestly, guys, even if Baba was up 100% since the release of the 5-part video series, I likely wouldn't have sold. I may have taken some off the table, let's be honest, but I probably wouldn't have sold a lot. And this is because I expect that the company to excel in multiple business segments, including China commerce, cloud computing, and logistics, which can 5 to 10x their EPS over the next 15 to 20 years. I'm in this guy for the long term, guys. So the real question I'm sure a lot of you want to know is, what is the guy who made a 5-part series on Baba doing now that the stock is cratering? So the short answer is literally nothing. I'm waiting for the share price to decline even further. I'm getting greedy here, guys. The average purchase price that I have is approximately $200 a share, and I would love to double that if the shares get to approximately $100 a share. I honestly don't think that it will get to $100 a share, so I'm looking to sell cash secured puts at approximately $120 per share that have an annualized yield of approximately 20% at the minimum. So I'll say it again, I'm getting greedy as this thing declines because I've already built up my base position. So why am I looking to sell cash secured puts as opposed to just buying the dip? Now, before I tell you, let me just remind you to please smash that like button. It really helps YouTube know that this channel provides valuable content, and thus they'll share it with more viewers like yourself. Okay, so why am I using a cash secured put strategy? It's because my base position price is approximately $200 a share. I would like a steep enough discount to that before I buy more shares. So to me, that price would be approximately $100 to $120 per share, or like a net $100 a share looks really good to me. I'm going with a cash secured put strategy because that way I'm being paid no matter what, either with purchasing the shares at approximately $120 less the cash secured premium, which could bring my net price down to approximately $100 a share, or by just having the cash secured puts expire valueless and keeping the premium. As the funds are theoretically locked up because they have to be available to purchase the security if the shares decline further, I need to generate an acceptable annualized rate of return on those funds, which is why I'm targeting a 20% annualized return at the $120 strike price. Now, if we look at the 1 year out cash secured put yield, the 120s are paying approximately $10 a share, which reflects an 8% cash secured put yield. So that's under our 20% yield expectation. We would need that premium to be approximately $24 a share. Now, we can use shorter durations to find higher annual yields, but I've already done that. There's nothing really close to it. So I'll leave it at that, and I won't clutter up this video by showing more durations. I'm not gonna lie, I don't think it'll decline as much to see the cash secured premium that high, but I've been investing a long time and I've seen much sillier things happen. So is there a possibility that the shares could decline enough to give me that yield? Absolutely. Is it probable? I don't think so. Now that you know that I'm sitting tight and not really doing anything with my BABA holdings, I wanted to quickly talk about emotional intelligence and investing. How is it that with being in the red by tens of thousands of dollars in this position, I could even fathom buying more? And that brings me to a concept that I wanted to discuss in this video, and it's the concept of emotional intelligence when it comes to value investing. The answer to why I could be buying when people in the media like Jim Cramer are saying that China is completely uninvestable and super investors like Cathie Woods is selling out really lies in my mental model towards investing when my stocks are down. I'm gonna open up to you guys and show a bit of my vulnerability here. The truth is, with money and investing, I am super emotional and I have anxiety that leads to me constantly second guessing myself. Success in investing is not how well you can make investments, it's about how you can stay in your investments when things go wrong with either the company or the stock. The way that I do this personally is by building elaborate models on every company that I buy and learning as much as I can about them to make intelligent investment decisions. Although this process is slower and I'm often late to the party when it comes to buying up stocks, I know that I'm covered if things turn. So if something goes wrong, like the crash in the BABA stock price, I just open up my model and relax knowing that my research is sound and correct. All the anxiety and second guessing myself goes away. And once the emotions are controlled, I go and buy more stock precisely when everyone else is scared and selling at the bottom. So the point I want to make here is that we all get emotional when it comes to our money and we have to find ways to control it. I just told you what my method was. What's yours? Let me know in the comment below. I'd love to make a video featuring your strategies on controlling your sell low instincts. I think that it could really help a lot of people. Also, I want to talk about another dangerous practice which I'm seeing more and more of now, which is groupthink. I think we have a ton of groupthink in the value investing community. I believe that you should have so much conviction in your position that it doesn't matter at all what the super investors are doing. And the only way to do this is by doing all the research yourself and building out the models necessary to support your position. Now, that's just my opinion. I doubt Buffett builds out intricate Excel models, but it's how I do things. Now, this brings me to many of the value investing YouTubers on this platform. The one point of contention that I have is that many of them are buying BABA partially on the basis that guys like Munger and Manish Pabrai bought shares in the company. They're telling their viewers to trust in BABA because the said super investors have blessed the stock with their presence. Which is ironic because value investing in general is supposed to be about doing the research and getting to the right due diligence. And yet, there's people that are acting like groupies just following what the big dogs are doing. And I'm not saying that to be a jerk or judge or anything. All I'm trying to say is that if you outsource your due diligence, even partially, what do you do if the super investors leave? This could lead to mistakes being made as you're viewing the company as more favorable because some investor that you respect owns the company. The opposite of that is that you would then view the company as less favorable if the super investor left. That's a mistake. So the big takeaway is that it is immensely easier to become wealthy if you find a way to build in a process that enables you to have a high level of emotional intelligence into your investment strategy. That way you will avoid buying stocks at the top when everyone is excited and FOMO comes over you. You will also avoid selling stocks at the bottom when the fear of losing more money comes over you. Often from someone saying something like, well, I'm glad I didn't buy the stock when you did. I'm glad you didn't buy it either, because with that mentality, you would have sold at the bottom. So I'm glad you saved your money. You're better off owning ETFs. So to sum it up, what am I doing with the BABA share price decline? I'm sitting tight and waiting for the share price to decline further so I can dollar cost average down. I'm also watching the company's operations in detail to make sure that everything is running smoothly. Will the company have operational hiccups? Absolutely. Every company goes through its issues, but overall, is the business operating well? That's what I'm looking for. Note, of course, that I'm not going crazy and buying as much of BABA as I can. I still have to balance and diversify the portfolio correctly. So I do have limitations that I have to work within. And the underlying assumption within those limitations is, can I be wrong on BABA? Absolutely I can. But everything right now seems as though it's going to expectations, but we'll see what happens in the future. So I will work within the limitations that I've given myself. I really hope that I've helped you guys. If you're not subscribed, please consider doing so. And if you haven't yet done it yet, please smash that like button. I'll see you guys later.